Chapter 12, Learning Target 2, Using Net Present Value Concepts to Make Investment Decisions. Before we get started, let's review just a term that we know. Net present value analysis is a method of evaluating investments that uses the time value of money to assess whether the investment's expected rate of return is greater than the company's cost of capital. If the expected rate of return is greater than the cost of capital, then the company should acquire the asset. If the expected rate of return is less than the cost of capital, then the company should not acquire the asset. The net present value method of selecting appropriate investments also consists of 4 steps. Step 1, estimate the timing and amounts of relevant cash inflows and outflows. Step 2, calculate the present value of all relevant cash inflows and outflows. Step 3, determine the net present value. And step 4, accept or reject the proposal. Now, when looking at net present value, there's a couple key points. Key point number 1 is basically the net present value technique does not, key phrase, does not indicate the expected return of the investment, but rather, or its possibility, but rather only that the expected rate return is greater or less than the cost of capital. If it's greater, it's a positive net present value, which is what we're looking for. If it's less, that's a negative net present value, and that's what we're not looking for that. Now let's take a look real quick before we finish about cash inflows and outflows. Cash inflows, as you remember, is money that is coming into the business. Also money that could be saved too. We'll talk about that in a second. Some sources of cash inflows, cash receipts from using the asset. Another one, decrease in working capital requirements. Next one would be sale of old assets, and then sale of new assets as well. Those are some sources of cash inflows. We can sell that new asset obviously at the end of the project. Also, tax savings due to tax shield, which we'll get into a little bit later. So now we talked about cash inflows. Let's talk about money that's going out of the company, or in other words, cash outflows. So some sources of cash outflows. First, we have cash paid for operating expenses, or operating the asset, whatnot. Next one would be increase in working capital. Let's say we need more money to be able to run this new asset. Cash expenditures from using the asset. So in other words, some cost of electricity or heat. Now, those are cash outflows. And the final key point before we finish up here is this. When you look at cash inflows, a decrease in the operating expenses is considered a cash inflow. And the reason being it's considered a cash inflow is because it increases the cash flows of the company. Or in other words, savings equals cash inflows. Hope this helps, and we'll see you in class to do the in-class assignments.